Coming out of Frankfurt and bowing to increasing shareholder pressure, Deutsche Bank said on Sunday that its co-chief executives, Anshu Jain and Jürgen Fitchen, had resigned and would be replaced by John Cryan, former chief financial officer of the Swiss bank UBS. Now, some large shareholders had called for Mr. Jain and Mr. Fitchen to step down because of a series of large legal penalties imposed on the bank for past wrongdoing, as well as inconsistent profit and questions about the bank's strategy. The resignation of Mr. Jain, who is 52, will take effect at the end of June. Mr. Fitchen, 66, will stay on for another year to ensure a smooth transition, Deutsche Bank said. Although some shareholders had been clamoring for a change in management, Mr. Jain's resignation still comes as a surprise, because less than 3 weeks ago, Deutsche Bank's supervisory board had granted him more power, actually giving him direct responsibility for a reorganization plan intended to simplify the bank, save 3.5 billion euros, and produce a profit equal to at least 10% of the capital invested. Well, a person with knowledge of the situation said that, although he had been under pressure from shareholders, Mr. Jain was leaving of his own volition, and he will not collect a 15 million euro severance payment he would have received if he had been fired. Mr. Jain has worked at Deutsche Bank for 20 years and played a major role in establishing the bank as a force on Wall Street and a credible rival to American investment banks like Goldman Sachs and JP Morgan Chase. But since becoming co-chief executive in 2012, Mr. Jain had faced questions about whether someone so closely identified with the investment banking unit was the right person to deal with serious accusations of wrongdoing. Because the misconduct at Deutsche Bank has almost always stemmed from activities at the investment banking unit. Back in April, Deutsche Bank agreed to pay $2.5 billion to the United States and British authorities to settle accusations that some employees had conspired to rig benchmark interest rates. While Mr. Jain was not accused of taking part in the conspiracy, some shareholders said he handled the investigation and settlement badly. Well, because the fine was more than other banks paid in the same case. And reflecting what the authorities said was foot dragging by Deutsche Bank in providing information to investigators. And get this. In late 2013, the Federal Reserve Bank of New York sent a letter to Deutsche Bank directing it to fix long-standing deficiencies in its financial reporting procedures. And according to Janet Tavakoli, who is president of Tavakoli Structured Finance, Inc., which is a consulting firm in Chicago, and she effectively points out that, quote, Deutsche Bank has critical operational issues and management issues, because one cannot effectively manage risk or measure the current situation when your internal paperwork and records are not in order. And this has been Me the People. Break this news.